If we're to look at the condition of debt markets, the cost of credit, the availability of credit, it's been severely constrained over the last 18 months, going from a period of easy credit where the risk premium was zero and credit was freely available to anyone who asked. Risk ratings blew out, credit was very expensive, if it was even available. Now has started to loosen up, credit is more available, margins have come down, banks are more willing to lend, but still very constrained, even compared to before 2005. You can argue whether 2005, 2006, 2007 was a period of excess credit, which I think would be true. Going forward, what is that going to look like? We've done some studies into this, including a survey of lenders at Jones Lang, and found that although lenders expect margins to come down over the course of the next 12 to 18 months, they're going to come down slowly, for one thing. Secondly, they're going to come down at the same time that interest rates are very likely to rise, central bank rates and government funding rates. So the impact of those two pieces, the cost of credit really doesn't get much cheaper over the next 2 years. The price stays about the same. Banks might be more willing to lend. Go back 12 months, development finance simply wasn't available. In trying to develop a new site, no one was going to lend on it. Today, still very difficult to get, but not impossible. 12 months from now, with the shortages that are developing in some markets around the world, shortage of supply, of new real estate supply coming online, development finance will become more available. So I think while the price of debt will not come down, its availability will increase as we build into the recovery. We're not going back, or when we go back to normal, normal isn't, I think fairly obvious to say, normal isn't 2006. Normal is probably something more like 2002 and 2003.